Hi everyone, welcome back to the US CPA classes for regulation exam. In this particular video of US individual taxation, we are going to start the applicable adjustment to gross income. This is part 1. In this part 1, we are going to cover military combat pay, retirement plan, simple plan, health insurance plan, and the qualified charitable plans. Right? So let's dive into to understand all these couple of applicable adjustment to gross income for individual taxation in United States of America.
Is there any cap in US for the amount of this family loss, family loan loss? When they're going to set off?
No, I think the simple rule is very simple. When you are submitting this form 8949, there it will go the detail. That means if you are claiming this as a non-business wet debt, then you have to provide that detail. So it will be part of this.
Okay, so mandatory to provide in every case.
Mm-hmm.
Okay. Okay, thank you.
Right. So we have covered like the income part. If you remember, like third chapter was all relating to capital gain, which we have discussed. And in this fourth chapter, initially we have gone through all category of income. Then we have gone through all special category of income also. Now we are jumping onto the today's main topic, which is exclusion to reach at gross income and deduction from the gross income to arrive at AGI. So that is second and third point which we have discussed in above small table of computation of income. So first left hand side if you see is all exclusion to reach at gross income. That means the income which is not part of taxable income basically, which we call it exempt income most of the time what we call it in India, right? So that is considered exclusion to reach at gross income. And deduction from gross income to arrive at AGI are generally those expenses or payments which you can reduce to arrive at adjusted gross income basically. So that is the principal difference between these two items. So first we look at exclusion to reach at gross income. Then we jump onto the deduction from gross income to arrive at AGI. If you see left hand side, the first point is military combat pay, right? So if you remember yesterday also we touched base this point, military combat pay, right? So any normal income of any military person is considered as taxable income, but when he or she is getting the military combat pay, that is like kind of exempt income or should not be included in the income. So military combat pay is basically hardship allowance when the military person is in war zone basically, right? So yesterday if you remember we were discussing US has their military in the different countries as well. If you see like NATO, they have like almost 26 countries who are being part of the NATO, and in almost all the country they have like US militaries deployed over there. Same way if you see like in the I think 2 years back when we were seeing like this Taliban here right episode has happened. So what has happened, like US was there for US military was there from last 20 or 25 years, and finally they have vacated Taliban when this Taliban rule has been came over there, right? Same way in this Iran Iraq, if you see in this war, so at this point of time there's a lot of military from the US which is being in Iran, and sorry, being in Israel, sorry, and fighting with Gaza party and other kind of things, right? So same way like they have a lot of military deployed here in like our coast, Hind Mahasagar, what you call it, our coastal area also. If you see like in Maldives, Malaysia, or maybe Indonesia, or maybe Taiwan, if you see like there's a lot of tension between China and Taiwan. The main region is like US, to be very honest with you, right? US, generally do not come in front of the war, but if you see any of the war in the world, reason behind that is uh, common, right? So they deploy a lot of military in the different countries as well, and which resulting and when they deploy the military, the people who are in the military and who are in the war zone, they get military combat pay, and that is tax-free income for them, right? Second is retirement plan benefit. Roth IRA received. I think have we gone through the IRA individual retirement account topic? Have I given you the overview about the
No,
individual?
sir. This is pending.
Okay, okay. So maybe it will be coming after this. That will be part of the deduction. So that will come later on. But if you remember on day one when we started this regulation class, so at that point of time, I have given you the high level overview about the individual retirement account. So individual retirement account are of two category. One is traditional IRA and one is Roth IRA, right? So in the traditional IRA, there are two subcategory. One is deductible traditional IRA, second is non-deductible traditional IRA, right? So in short, if I summarize everything, there are three category of IRA. One is deductible traditional IRA, second is non-deductible traditional IRA, and third one is Roth IRA. So deductible traditional IRA, as the name suggests, when you are depositing the money, you are deducting it. That means you are using it for the deduction, itemized deduction, which we will be discussing, right? And later on, when you receive the money, right? For example, like after the retirement. So this is like kind of individual retirement account. That means throughout your life, you are making the contribution, and after the you can say retirement, you'll start getting the pension or annuity kind of thing, right? So in the traditional deductible IRA, as the name suggests, deductible IRA, that means in the year when you are making the contribution, you can deduct the money as an itemized deduction, and later on in future after the retirement when you are receiving money, then that money is taxable, which is principal as well as interest which you have earned, or maybe earnings which you have earned on the IRA. So that both are being taxable in future year when you are receiving money back after the retirement. On the other side is traditional non-deductible IRA. So traditional non-deductible IRA, as the name suggests, it is non-deductible. That means in the year when you are making the contribution, you cannot deduct that for a tax purposes. But in future year, when you are receiving money back from the traditional non-deductible IRA, so your principal is not taxable. Only the interest or earning will be taxable. Third category is Roth IRA. So don't worry, we'll be discussing in detail when we reach to this particular topic. Here I'm just giving you the high level overview again, because this overview I have already shared in first or second class when we started the regulations topic. But I'm just reiterating the same thing which we have discussed in those class. Third category is Roth IRA. So as the name suggests, Roth IRA, this came into effect under the TCJ Act 2017. So under the Donald Trump administration, this has been passed, and it is considered as like the young age individual retirement account. Basically, most of the young people do contribution in this retirement plan because it has recently came, and with the consideration of the youth of the America. So in this, basically, it is also a non-deductible IRA. That means when you are making the deposit into the Roth individual retirement account, so during the year when you make the payment, that is not non-deductible. That means you cannot claim any itemized deduction for the same. But later on in future, after the retirement, when you receive money back, so neither the principal is taxable nor the interest is taxable or earning is taxable, right? So here what they are saying, the retirement plan benefit received. So the Roth IRA benefit which is received after the retirement are exempt income. So this is what it means over here in point number 2. Clear? Yes, no,
Yes, sir.
right?
Yes,
So
sir.
don't worry, we have like dedicated topic of IRA in which we'll be discussing everything in detail, but I'm just reiterating the high level summary which we have discussed earlier, because IRA is the topic which is common, like it comes at various places, and it is very important topic as well for exam purpose. So we have like thorough session on that. So we'll be discussing, but here just understand what is Roth IRA. So Roth IRA is non-deductible IRA. So at the year when you're depositing the money to the Roth IRA, you will not get any tax benefit. But in future year, when you are receiving the money back, neither the principal is taxable nor the interest or earning on that IRA will be taxable. So this is what they are saying. In future year, when you receive at the retirement time from Roth IRA, it is exempting. Right. Next is retirement plans, which is deductible. So deductible retirement plan, which you receive in future, so the principal amount is not considered as part of your income. Next is simple retirement plan for small businesses. So IRA is basically individual retirement account where you as an individual do the contribution. But if you see in India also, you have like defined benefit plan or defined contribution plan where employee and employer both make contributions, right? So same way in US also there are many plans. So one is like simple plan, 401k plan, 403b plan, SCP plan, right? So we'll be discussing all those category of the plans in which employee and employer they both make contribution, right? So what they are saying, the simple retirement plan for small businesses. In US, for small businesses which has less than 100 employees generally, there is a plan called simple plan in which employer and employee they both make contribution, right? So the employer contribution is not part of your income. So this is what it means, right? Next is health insurance premium paid by employer. So like in India also, if you see like like many of the big company has requirement to take a group insurance policy, right? Any idea about group insurance policies which employer take? Do you guys being part of group insurance policy of your employer?
Yes, sir.
Hmm?
Yes, sir. There's certain limit which employer gives to employee for
Hmm.
the medical uh, sub coverage.
Yes, yes. So same way, like health insurance premium paid by employer up to certain amount is not considered as part of your income. Like for example, it is because it is mandatory for employer to have like minimum you can say medical insurance of their employee. Right. Same way in India, if you see, I think either it's 3 lakh rupees or 5 lakh rupees up to that. Like like if you have more than 100 employees, it is mandatory for you to have a group insurance policy for all your employees. Right. So same way, when under the group insurance policy or health insurance premium paid by employer, to that extent, it is not part of your income. Same way, if you see that is never being part of your CTC and it's not come into your Form 16 as well, right? Make sense?
Yes, sir.
Next is qualified charitable distribution over the age 72 maximum on or before. One second. Once again, over the age 73. I think this is not relevant now. Yeah. So, qualified charitable distribution over age 73 and the maximum amount is $100,000. So, when you have when you like every year depositing money with the IRA, right? So, IRA says after the age of 73, you must do the required minimum distribution. So, that also will be studying along with the IRA topic. So if you have deposited money in the deductible IRA, right? That means in future when you are receiving the money back, it is being taxable. However, if you make that money into a qualified charitable contribution or distribution, then up to $100,000 is not part of your income, not considered as part of your income, right? Next is child support received from employer. So
Sir,
yes,
can you please elaborate a little bit more about qualified charitable distributions? How does it happen in USA? In
yeah,
India, we don't receive anything, whatever we are donating. So whatever we are donating is a kind of a donation. We never going back any money out of that from
yeah.
any institute.
Yeah. So no, I think maybe let me elaborate what you are saying. Like that was not the intention. So like individual retirement account, like your pension plans, basically, right? So which we were discussing earlier. There are three type of individual retirement account, which is traditional deductible IRA, traditional non-deductible IRA, and Roth IRA, right? So for all this kind of retirement plan, throughout the life you deposit the money, taxpayer deposit the money. So government mandate that after the age of 73 you must you must withdraw the money from those retirement account, right? Otherwise what you will be doing, you are every year depositing the money but not withdrawing. So it may be possible that someone is rich, right? Or it may be possible someone do not need it, right? Or it may be possible someone wants to donate it, right? So in that case of scenario, the government says like after the age of 73, like if you see in India, the scenario is very opposite. There are many people who deposit so much money throughout their life into the pension account, right? And maybe fortunately or unfortunately, if they die, right, then all money is being captured just into the bank account of the government, right? And there is billion and billion dollars of money is being lying in bank account for respective banks or respective pension account because the people died and they do not claim for the you can say pensions, or people are not literate enough to claim for their respective pension. But is in US government push to their citizen that after the age of 73 you must do the minimum required distribution, right? So this is about that. So when you do minimum required distribution, right, if it is from traditional deductible IRA, which we were discussing earlier, traditional deductible IRA mean in the year when you have made the contribution you have received a deduction, right? So in future when you are receiving the money back, principal and interest they both are taxable, right? Or second scenario is traditional non-deductible IRA. Traditional non-deductible IRA means in the year when you are making the contribution, you are not receiving any tax benefit, but in future year after the retirement, when you are receiving money back, the principal amount is non-taxable, but earnings will be taxable, right? So they are saying after the age of 73, you must have to withdraw the money. There is minimum withdrawal is required. So if you withdraw that money and deposit to a qualified charitable institution, then up to $100,000, it is not considered as your part of your income. This is what it means.
Okay.
Yeah. So this is different. Like we don't have any such thing in India. Make sense?
Yes, sir.
Hmm. Next is child support received from employer. That means employer is providing any child support to employee, right? For example, I would say uh, maybe if like both husband and wife are working in an organization and the employer is providing the nanny support, right, to take care of their kids, or maybe like their education expenses, or maybe their preschool expenses, kind of thing, right? So up to certain limit, which like which is in part of the employer um, responsibility, to that extent it is not considered as part of your income. But over and above, if you're receiving the more money, then it will be like a fringe benefit. Next is child care facility received from employer. So earlier was child support, right? Child support received from the employer, where you are receiving the you can say money for taking care of your child, right? And here child care facility mean for example, like in big company in US like Google, Apple, Amazon, or other big firms like EY, PwC, KPMG, they have, like the separate play area within the office where like the working parents can bring their kids, and like they have all the facilities to take care of their respective childs, right? So in that case of scenario, for single married filing single or married filing separately, up to $3,000 is not considered part of the income, or married filing jointly up to $6,000 is not considered as part of income. Or maybe sometime, like the employer provide the money to the employee for making some special infrastructural or facility arrangement at their home for taking care of their child. For example, like setting up some PlayStation, or maybe any like you can say toaders or other stuff, right? So for that also, if you are, it is relating to facilities. The first one was relating to the support. So facilities mean more of, like capital expenditure, I would say. So up to $3,000 and $6,000 for respective, like single or married filing separately or married filing jointly, accordingly, is not considered as part of your income. Right? Clear, everyone?